Yes, fine. We'll start. Now we will discuss September 2025 RTP, that is the direct tax component. Guys, before we start, just a disclosure. For September exams, there are no exclusive amendments for income tax. That is, in income tax, there are no amendments for September exams. There were already an amendments applicable for May exam. Same thing will continue even for September exams. So with this, we'll start first solving the MCQ. There is a case scenario question. First, we'll quickly go read the requirements and come back as quickly. How much amount would be taxable in respect of income earned by Mr. Manish for let out of residential and commercial units under which head? Okay, that is normally rental income will be taxable at the head house property, but if the assessee is in the business of letting out of commercial properties, then the rental income will be taxable under the head PGBP. Yes, sir. We will see what is given in the question. Next, what would be your answer to MCQ 1 if Mr. Manish is not a real estate developer and has a business of letting out of properties? That is, he is doing in the course of business. Next, third one. What would be the tax treatment of vacant residential and commercial units held as stock in trade during the previous year 24-25? That is, there are some units which are vacant. What is the tax liability of that? They are asking. Okay, that's is there. Fourth one also. Which of the life insurance policies would be exempt at the time of maturity proceeds? So that means this question is on 1010D. Then the last one, what would be the income taxable in the hands of Mr. Manish from the firm Zoco and Associates for assessment year 25-26? So these are the MCQ question guys. Totally 5 questions are there. We'll now read the story. Case scenario, Mr. Manish is a real estate developer. His main business is construction, development and sale of residential properties. Clear? So he is not in the business of renting. His business is to construct a house and to sell it. He developed a project named Ashiana Evan, which has both residential and commercial units. He obtained a certificate of completion for the said project on 1st February 2023. Guys, date is important. Completion certificate is obtained on 1st February 2023. He sold majority of the units, however, 15 residential units and 10 commercial units were not sold and held as stock in trade. Means whatever he has constructed, he had sold majority of them, but 15 residential units and 10 commercial units remained vacant as stock in trade. And please be careful, for real estate developer, the house or the residential units, whatever he is constructing, including commercial units, will become an inventory. It is a stock to him. And when it is sold, where is it taxable? Under the head PGBP. If it is sold, it is not capital gains. Please be careful. It is taxable under the head PGBP. Okay, sir. To earn some income from such units, he let out 10 residential and 5 commercial units. Okay, 10 residential and 5 commercial units. From 1st May 2024 at 15,000 per month and 20,000 per month each respectively. This is the actual rent tax. Actual rent. See, please be careful. So it is given from 1st May. That means 11 months in rent you have to consider. April will not. Only from 1st May to 31st March. Okay, sir. Expected rent of each residential unit is 14,000 and 22,000 per month for each commercial unit. All units are identical. All units are identical means what? They are same to same. They are same to same. Observe guys, see what is the actual rent for the residential unit? 15,000. What is the expected rent? 14,000. What should we take? Whichever is higher. So what is the GAV? What is the GAV? It is 15,000 for residential unit. Then coming to commercial unit. Sir, what is the actual rent? 20,000. What is the expected rent? 22,000. So what is the GAV? 22,000. Hope you are getting it. Whichever is higher, right? Actual rent or expected rent, whichever is higher. Sir, what about expected rent? They have directly given. Don't worry about the first two steps. What is the actual first two steps? Municipal value or fair rent, whichever is higher. Compare that with standard rent, whichever is lower. Correct? Yes. But straight away they are given expected rent. We will take that and compare it with actual rent. Okay, sir. Done with that. Next, Mr. Manish is also engaged with a firm, Zoco and Associates, as a sleeping partner. The firm has 3 partners. Guys, please be careful. He is a sleeping partner. What does he do? Sleeps. Sleep well. The firm has 3 partners. His capital in the firm is 10 lakh. Each partner received interest at 15% on capital from the firm and remuneration at 30,000 per month. Guys, important. Interest and remuneration are authorized by the partnership deed. The book profit of the firm for previous year 24-25 is 9,50,000. Guys, this is a trap. Misleading information. Why? Because this one especially is a sleeping partner. For a partnership firm, as per section 40B, remuneration paid to sleeping partner, is it allowed? No, it is not allowed. Is it taxable in the hands of partner? No, because what is allowed for the firm is only taxable for the partner. Sir, what about interest on capital? Is it allowed for sleeping partner? Yes. So for interest on capital, there is nothing called working partner, sleeping partner. Only remuneration should be paid to working partner. Only then it is allowed. Oh. But what is the maximum interest allowed as per section 40B? 12%. Correct. Oh. 12%. Yes, sir. But how much is paid here? 15%. See, partner will receive 15%. But how much is allowed as an expenses in the hands of firm? 12%. Same thing is taxable in the hands of partner under the head PGB. Under the head PGBP. Sir, what about the remaining 3%? Not taxable. Not taxable. Why, sir? Because it is disallowed in the hands of firm. What is disallowed there is not taxable in the hands of partner. Okay, sir. So that was about partnership form. Then they have given some information about the life insurance policies. He has taken 4 life insurance policy. The details of such policies are given here under. Date of issue is given, annual premium is given. Guys, whenever we are comparing annual premium with sum assured, we should take excluding GST. They have already given excluding GST, but sometimes they might give including GST. Should we consider GST also? No. Please be careful. Whatever figure premium is given here is excluding GST. When we are comparing the 10%, 15%, 20% is there now. Clear? Sir, should we take including GST or excluding GST? Excluding GST. Clear? And we have to compare with what? Sum assured. Okay. 4 lakh is the premium paid, guys. Policy is taken on 1st April 2021. So, your sum assured is 35 lakh. 10% of 35 lakh comes to 3 lakh 50,000. 3 lakh 50,000. Whereas here premium paid is 4 lakh. It is more than 10%. Even in 1 year, if it is paid more than 10%, correct? No, more than 10%, even in 1 year, if it is paid, exemption is not available. So for this, no exemption. Next, coming to B. Policy is taken on or after 1st April 2023, or else it is exactly 1st April 2023. Okay, sir. Premium is 1,50,000. What is the sum assured? 14 lakh. Take 10% of 14 lakh, which comes to 1,40,000. Whereas you have paid 150. Here also it is more than 10 days. More than 10%. Can we enjoy the exemption for it? No, sir. Both the policies are not exempt if it matures on the expiry of the term. Sir, what if insured is gone? Then it will be fully exempt. Clear? If question is silent, obviously don't make him die. Okay. Assume that he is still alive. Oh. They have also given the date of maturity and all. Means assuming if he is alive till the date of maturity, we need to answer which policy is exempt, which is not exempt. Oh. Then C, it is taken on 1st February 2024. Guys, for this, 2 conditions are applicable. 10% is also applicable, plus 5 lakh limit, monetary limit. That is also applicable. 5 lakh monetary limit is also applicable. Hope you guys remember. If the policy is taken on or after 1st April 2023, the yearly premium cannot be more than 5 lakh. Cannot be more than 5 lakh, plus percentage wise, it cannot be more than 10% of the sum assured. Yes, sir. So it is 2 lakh here, but the sum assured is 22 lakh. So 22 lakh into 10%, it comes to 2 lakh 20,000. So is it within that? Yes, sir. So less than 10%, not a problem. Next, D, it is taken on 1st July 2024. So even for this 5 lakh limit is applicable? Yes, sir. So premium is 3 lakh, whereas sum assured is 31 lakh. 31 lakh into 10%, 3 lakh 10,000. So 3 lakh is within that. So that means, is it within 10%? Yes, sir. But please be careful. Both these policies is taken on or after 1st April 2023. If you add up both, what is the aggregate premium? 5 lakh. Aggregate premium cannot cross 5 lakh. So can we enjoy exemption for both? Yes. Sir, what if by chance, if for this it was 4 lakh? Just assumption I'm telling you. You cannot claim the exemption for this. You can claim for this or else only T. You cannot claim for both, either of the two. Okay, because aggregate premium also cannot cross 5 lakhs. Clear? Individually it is within 5 lakh. But if I add up both also, exactly 5 lakh. Exactly 5 lakh is okay, but you cannot cross 5 lakh. Got it? Yes, sir. I will just show you. If you want, I will just have a look into just a minute. This is covered under section. I covered it under IFOS, income from other sources tax. Yes, this one. Okay. Because if policy matures, where is it taxable? Under the head other sources. So you can see here, if policy is taken on or after 1st April 2023, two things we have to check. Whether whatever premium you are paying is within 10%, that is exactly equal to 10% or less than 10%, plus aggregate premium cannot cross 5 lakhs. Yeah. Even before that, percentage limit was there, but monetary limit was not there. Clear? And 15% also is there. That is only if the policy is taken in the name of some selected people. If question is silent, please always apply 10%. Don't apply 15%. If they themselves give that assessee is covered under so and so section, that is ATU or ATDDP, only then you take 15%. Got it? Yes, sir. Sure, we are done. So based on the facts of the case scenario given above, choose the most appropriate answer to the following multiple choice questions. So totally 5 questions are asked. One by one we will answer. How much of the amount would be taxable in respect of income earned by Mr. Manish for let out of residential and commercial units under which head? Guys, first of all, we will decide which head. Where is it taxable? IFHB. Income from house property. Sir, why? Guys, he is a real estate developer. Whatever units he has constructed is a stock to him. If we sell it, it is taxable under the head PGBP. But sir, before it is sold, the unsold properties is let out. Whatever rental income is earning, where is it taxable? IFHB. Income from house property. But if commercial properties are let out in the course of business, then it is taxable under PGBP. But they clearly told, no, he is in the business of sale of commercial property or residential property. But whatever is letting out is like for a part time, okay, time being. Because until it is sold, let us let out for few months. Is it clear? So both the incomes are taxable under the head income from house properties. Got it? Yes. So how much is that? We will count. Listen here, easy. Residential unit. I have done the calculation here. Residential unit you observe. GAV. Guys, what is the gross annual value? I already told you. 15,000 or 14,000, whichever is higher. 15,000. 15,000 into how many months? 11 months. Hello, 11 months. Because from 1st May. Yes, sir. You will get GAV. 30% standard deduction. Because question is silent about municipal tax paid and interest. Ignore both. Okay, sir. So you'll get 30% standard deduction. 49,500. So what is the income from house property for one unit? 1,15,500. So totally how many residential units are let out? 10. Please be careful. 10. 15 are there, but out of that, how much is let out? Only 10. Only 10. Okay. Into 10. So it comes to 11,55. Sir, can I straight away do into 10 here also? Fine. Okay. You will get same. I did it ultimately because we are doing MCQ now. Try to get it as early as possible. This is about residential unit. Coming to commercial unit, you need to take actual rent or expected rent, whichever is here. So 22,000 into what? 11 months. That is from 1st May to 31st March. Okay, sir. This 22 is nothing but expected rent tax. So reduce standard deduction 30%. So you will get income from house property for one unit into 5. You will get income from house property. Okay, now. So this is from residential unit. This is from commercial unit. So 1155, 847. 1155, 847. Both are under the head house property. Please look into which head also. Sometimes they would have given same figure but under different head. Don't get trapped. Okay. Yes. Sure. Next. What would be your answer to MCQ 1 if Mr. Manish is not a real estate developer and has a business of letting out of property? Important. If assessee is in the business of letting out of property, then whatever is earning from letting out of commercial property, taxable under the head PGBP. Letting out of residential property is taxable under IFHP only. That is income from house property. Please be careful. This is an amendment. It was an amendment for May exam itself. I repeat, whatever is earning rental income from letting out of commercial property in the business, taxable under PGBP. Residential units, house property only. Sir, it is in the course of business, no problem. Still under house property. So for house property, it is same guys. Residential unit, same 11,55,000, whatever we calculated above. But for commercial unit, it will change. Please be careful. Why, sir? Under PGBP, we don't have this. Sorry, commercial, no. we don't have this 30% standard deduction. You are not eligible for it. Hope you got it. Yes, sir. So, for commercial units, what would be the income from business? It would be 20,000 straight away. Sir, expected rent also will not come there. Actual rent you have to take. Actual rent. Guys, because whatever actual rent or expected rent, whichever is higher, 30% of standard deduction. Where is it? In house property. Whereas here we are calculating this income under which head? PGB. PGBP. So 20,000 into 11. Why did you take 20,000? Actual rent. No question of expected rent here. Into how many properties? 5 properties. You will get how much? 11 lakh rupees. 11 lakh rupees. And here, under the head PGBP, if you have any expenses, you can claim it against it. But question is silent. So let us assume there is no expenses. So straight away 11 lakh. Hope you understood. This is a tricky point. Please be careful. For commercial unit, if you are calculating under the head house property, figure will be different. Under the head PGBP, figure would be different. Okay, sir. So 1155 and 11 lakh. 1155 and 11 lakh. Here it is. Let me just read it. 11 lakh 55,000 from residential unit under the head house property, correct? 11 lakh from commercial unit under the head PGBP, right? Sure. Third, what would be the tax treatment of vacant residential and commercial units held as stock in trade during the previous year 24-25? Guys, interesting. When the completion certificate was obtained on 1st February 2023. And in IFHP, there is a provision telling from the end of the financial year in which the property completion certificate is obtained for a property, you can have 2 years lenient period. Clear? That will come till when? 31st March 2025. If the property remained vacant till year, it is not deemed to be let out property. If it remained vacant even after this, then it is considered as deemed to be let out property. Even though it is vacant, still it will be considered as deemed to be let out property. Where is this provision, sir? Under IFHP itself. Income from house property itself. Got it? I repeat. For a real estate developer, where the residential units or commercial unit is an inventory, stock, if they have not sold it within 2 years from the end of the year in which completion certificate is obtained, after the 2 year period over, from the third year, it is considered to be deemed to be let out property. Even though property is vacant, still it will be considered as deemed to be let out property. Clear? So in our case, sir, totally residential units, 15 was there. Out of that, only 10 is let out. Correct? Remaining 5 is vacant. Yes. Same way. 10 commercial properties are not sold. In that, only 5 is let out. Remaining 5 is vacant. Yes. Is anything taxable from it? No. Because 2 year period is not yet over. When will the 2 years period will over? On 31st March 2025, which is the end of our previous year. So nothing is taxable during our previous year. Nothing is taxable during our previous year, guys. Okay, sir. Let us see. Where is it? No tax treatment would be there as the units were not let out and held as stock in trade, and 2 years have not lapsed from the end of financial year in which certificate of completion is obtained. This is actually right answer. Hope you understood. The 2 years will end on 31st March 2025, guys. Hope you understood. See, first log the date of obtaining the completion certificate. Take the end of that financial year. From there, plus 2 years. From there, plus 2 years. Other options, you can just read it once just to cross check. Okay. Because when first option itself is right, don't immediately mark. Better read other options and cross check once. Let me quickly read it. Vacant units would be deemed to be let out for 2 months, that is February and March. No. And expected rent would be taxable under the head income from house property. Wrong. Vacant units would be deemed to be let out for 2 months, that is February and March. And expected rent of residential units would be taxable under the head income from house property. And expected rent of commercial unit would be taxable under the head PGBP. No, wrong. Nothing is taxable. Last one. Vacant units would be deemed to be let out for 2 months, that is February and March. And expected rent would be taxable under the head PGBP. No, sir. This is also wrong. Yeah. So the right answer is A. Coming to fourth one. Which of the life insurance policies would be exempt at the time of maturity proceeds? Guys, at the time of maturity proceeds means it is not maturing during our previous year. Please be careful. Is it maturing during our previous year? No, sir. They have given some other year. But they are asking now itself the question. When it matures, will it be exempt or taxable? For sure, this will not be exempt. Why, sir? Because even in 1 year, if you have paid more than 10%, not exempt. Artha aita? Yes, sir. Whereas this, it is within 10%. And monetary wise also, it is within 5 lakh. So can we enjoy the exemption? Yes. Clear. So C and D is the policy which is exempt. But one thing you remember, guys, if by chance, if these two policies mature on the death of the insured, then irrespective of this percentage, it would be exempt. But when you are answering the question, don't assume death. Okay, assume the assessee is alive. Okay, even at this time, the assessee is alive. Got it? Because if you assume exam means, sorry, if you assume that he is died, okay, or dead, then everything will be exempt. All the policies would be exempt. Sure. So C and D, I guess, no? C and D. C and D is the exempt. Then, what would be the income taxable in the hands of Mr. Manish from the firm Zopo and Associates? Only income they have asked, not the head. But even if they ask the head, it is taxable to the head, PGBP, guys. So, what is taxable in the hands of partner? Only interest. Sir, is also getting remuneration? No, that is not taxable. Why, sir? Because it is disallowed in the hands of partnership firm. As per 40B, remuneration paid to sleeping partner is not allowed. Hence, not taxable in the hands of partner. So interest on capital is taxable. How much, sir? 10 lakh capital he has contributed, only 12% will be allowed. Correct? Because 3% is disallowed in the hands of whom? It will not be taxable. It will not be taxable. So how much is taxable in the hands of partner under the head PGBP, guys? 1,20,000. Here you need not answer with respect to head and all, but good to know. Where is it taxable? Under the head PGBP. Because sometimes along with money, they will also ask the head. Oh, done with MCQs, guys. Done with MCQs. Let us proceed further to descriptive question. Mr. Varun, an Indian citizen. Okay, somewhere it might help you. Somewhere it might help you. Engaged in consultancy business in India. He shifted to Dubai in the year 2019 to expand his consultancy business overseas. Okay, guys, he has set up his profession here, but now going to Dubai. Now going to Dubai. One thing you remember, somewhere it might help you. Profession is set up in India. Profession is set up in India. Might be now he is expanding to Dubai. But where is profession set up? In India. Correct. One of the important point for scope of total income, section 5. Last point is there now. Income earned and received outside India from business controlled in India or profession set up in India. Taxable, not taxable. Got it? For that point important. Yes, sir. Next. He visits India every year to supervise his office in Delhi. His stay in India for current as well as past years is as follows. Means how many days he was in India. First thing you have to look is our previous year. 100 days. First condition ruled out. First condition ruled out. Alva, yes. Why, sir? 182. Here it is 100. Correct. Other years also they have given 95, 105, 95, 75. Okay, sir. And don't waste too much time reading this, counting and sitting here only. Okay, let us see what is the requirement and accordingly do it. Clear? Because sometimes what happens now, history might not matter at all for us, our answer. Correct. The history might not matter. For example, assume is covered in explanation. Second condition is not at all applicable. Then I need to check only first condition. It didn't satisfy. Straight away I will tell he is non-resident. Correct? Yes. Chalo. During the previous year 24-25, he earned the following incomes. What are those? Income from consultancy business in India, 10 lakh. Is it taxable? Yes, people, taxable. Income from consultancy business in Dubai? No. But it is from a profession set up in India. It is from a profession set up in India. If it is ordinary or not ordinary resident, taxable. Agriculture income from a land situated in Kerala. Where is Kerala? Part of India only, na? Exempt. Dividend from an Indian company received in Dubai, doesn't matter, taxable. Indian company, no? Yes. Deemed to accrue or arise in India. Interest expenditure on investment in above shares, 15,000. This can be claimed as an expenditure. Maximum how much? 15,000 or 20% of 50,000. Correct. Now, interest expenditure can be claimed as deduction against dividend income. Maximum how much? 20% of dividend income, which comes to 10,000. 10,000 or 15,000, whichever is lower is 10,000. You are required to determine Mr. Varun's residential status for assessment year 25-26, assuming he is not liable to tax in Dubai. Okay. Compute the total income of Mr. Varun for previous year 24-25. If he opts out of default tax regime, means he is following optional scheme, guys. Optional scheme. Okay, sir. Chal, let us see the answer. Huh. See the answer, how they start. As per section 6, subsection 1, an Indian citizen who being outside India comes to India for a visit during the relevant previous year is said to be resident in India if he has been in India during the previous year for a total period of 182 days or more. Why, sir? Because he is covered in explanation. No second condition. No second condition. Let me just show it 1 second. Yes, you can see there are two conditions under section 6.1, guys. But as per explanation, so where is it covered? Here. Okay. So is engaged in the business profession or the vocation outside India, coming to India for a what? Visit during the previous year. In that case, second condition is not applicable provided his Indian income is up to 15 lakh. Clear. Sir, what if Indian income is more than 15 lakh? Then second condition is applicable, but instead of 60 days, it would be 120 days. Correct. So here Indian income matters. Indian income matters. So Indian income, is it up to 15 lakh or is it more than 15 lakh? And please be careful while calculating the income. What and all should we take? The word what they have used is income from foreign sources. See, the word what they have used. Let me read it here. Total income other than the income from foreign sources means while calculating this 15 lakh, we should not consider the income from foreign source. So what is the income from foreign source? Explanation is telling. Income from foreign sources means income which accrues or arises outside India, except income derived from a business controlled in India or a profession set up in India. In simple, as per section 5, income from foreign sources means only this one, sir. Just a minute, only this one. Clear. So rest all is considered to be income from Indian sources. Yes. Hope you are understanding. 1, 2, and 3A is considered to be income from foreign sources. Clear. Whereas, sorry, income from Indian sources. Whereas the last one is income from foreign sources. Is it clear? This is as per explanation to section 6. Okay, sir. Sure. However, if his total income other than the income from foreign sources exceeds 15 lakh during the previous year, then is second condition applicable? Yes, but as per the explanation, instead of 60 days, it is 120 days. 120 days along with 365 days. Both has to be satisfied. Yes. He will also be treated as resident in India if he has been in India for at least 120 days or more during previous year and has been in India during 4 years immediately preceding the relevant previous year for a total period of 365 days or more. Mr. Varun visited India only for 100 days during the previous year. So even though his Indian income is more than 15 lakh, still this condition cannot be satisfied. Why, sir? During previous year, he was in India only for 100 days. So how much ever is his Indian income? He is a non-resident. He is a non-resident. Yes. Mr. Varun visited India only for 100 days during the previous year 24-25. Yes, he is a non-resident as per section 6 subsection 1. Irrespective of whether his total income other than the income from foreign sources, is it more than 15 lakh or less than 15 lakh? Doesn't matter here. Why, sir? Because, guys, listen. I will just explain. If his Indian income, assume, is up to 15 lakh, then is covered in this. Second condition is not at all applicable. Only first condition. So what is it? 182 days or more. He didn't satisfy. Sir, what if his Indian income is more than 15 lakh? Then he is covered in this point. Second condition is applicable. Yes, 120 days. Did he satisfy that? No. Even this he didn't satisfy. So who is he? Non-resident. Non-resident, guys. As per section, now let us check deemed resident provision. Deemed resident provision. As per section 6.1a, there the number of days of stay in India doesn't matter. Number of days of stay in India doesn't matter. As per section 6 subsection 1a, an Indian citizen having total income other than the income from foreign sources exceeding 15 lakh during the previous year would be deemed to be resident in India in that previous year if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. So, but the condition here is Indian income should be more than 15 lakh. Clear? And anyway, he is not paying tax in Dubai, but he will be considered as a deemed resident only if Indian income is more than 15 lakh. Got it, guys? That is as per this one, guys. 6.1a. which I have given here as a note. Okay, sir. Let us check what is this income. Computation of total income other than the income from foreign sources. This is only to check residential status. To check the residential status. What all we should take, sir? I already told you. What all should we take, sir? Just a minute. I will show you. Okay, we should take 1, 2, and 3A. 3A, but not this one. Okay. Let us do it. Income from consultancy business in India, should we take it? Yes, sir. Indian income. Income from consultancy business in Dubai. Income is derived from a profession set up in India. Should we consider it? Yes, 3A. 3A in my table. Okay. Agriculture income is exempt, so exclude it. Then dividend from Indian company 50,000, but for that we can claim an expenditure. That is actual expenditure or 20% of the dividend income. Whichever is lower, so 10,000 comes as lower. Reduce it. Remaining is 40,000. How much it comes to? 14 lakh 40. Is he covered in deemed resident provision? No, he is not covered. Hence, who is he now? Non-resident. He is non-resident, guys. Oh. Since Mr. Varun's total income other than income from foreign sources does not exceed 15 lakh, is not deemed resident as per section 61A. Thus, Mr. Varun is a non-resident for assessment year 25-26. Guys, please be careful. What and all we checked? We didn't discuss this in one line. Where and all we checked? We checked totally three things. See, first, is he covered here? If yes, then is he a resident or not? Not a resident. If he is covered here, is he a resident or not? No, he is not a resident. Then if is he covered here, we check. Nowhere he is a resident. Clear. And please be careful. You cannot straight away go and check this. Because in the question they gave a clue that he is not paying tax in Dubai. So can I straight away go and check here? No. Section 61A is applicable only if you are not covered in 61. Only first you ensure that whether assessee is covered in 61. If not there, come and check 61A. Don't straight away go and check 61A. Okay, sir. Chalo. Now, they have also asked you to calculate total income of the assessee. Now, who is he? Non-resident. Guys, if he is a non-resident, please be careful. I am just playing around with the provision. Okay. Yes. If he is a non-resident, then this will not come. This will not come. Sir, profession is set up in India. No, sir. Yes. Observe this column. Observe this column. Only income earned in India or received in India is taxable. Whereas earned and received outside India is not taxed. Clear. So this will not come if he is a non-resident. Please be careful. Then previously you took no, sir. That was as per explanation to section 6, where they told the income from foreign sources is only this. So that is why I considered even this. Got it. Now we got to know he is a non-resident. Should we consider this? No. Because as per section 5, for a non-resident, this is not taxed. This is not taxable. Guys, students might miss out this. Other things are easy. This in one place we will consider it, in another place we don't consider it. Please be careful with this. Okay. So income from consultancy business in India, Indian income taxable. Whereas this one is important. This one is important. You can mark a star because student might miss out here. Why, sir? Because above we took it. 4 lakh we took it here. Whereas now we are not taking it here. Guys, here whatever calculation we did was as per section 6. Under 6 explanation is given. Where they told income from foreign sources means only the last thing we have to take it. That is 3B. 3B in my table. So should we take 3A, sir? Yes. And here, as of now, we don't know residential status. Irrespective of the residential status, we are taking 1, 2, 3A. To decide what? Residential status. Whereas now what are we deciding? We are deciding total income. Based on what? Residential status. Residential status we already know is a non-resident. So what should we take? Only 1 and 2. Oh, then remaining 2 is same, guys. Remaining 2 is same. Only difference is this one. Got it? Yes. So if he is a non-resident, what is his income taxable in India? 10 lakh 40,000. 10 lakh 40,000. Yes, people. Let us move to next question. Very interesting question. It was. Sixth question. Okay. First, let us read the requirement. You are required to compute the total income of Mr. Aryan if he is paying tax under default regime. Okay. Cost inflation index is given. From there only I can understand. This is a question on capital gains calculation. Mr. Aryan, a resident individual, okay, important, is working in Nischay Limited and earns a salary of 90,000 per month during previous year 24-25. Where is taxable? Where is it taxable? Salary. He holds 20,000 equity shares of Alpha Limited, an Indian listed company purchased on 1st January 2016 before 1st February 2018, where the cost calculation will change. Correct? Huh? It is purchased before 1st February 2018. We need to apply section 112A. When we apply 112A, cost calculation is different. We need to take FMV as on 31st January 2018 and all. Clear? Yes. At 200 rupees per share, that is cost of acquisition. Okay, sir. Next, this was acquired through a recognized stock exchange and STT was paid both at the time of acquisition and sale. Guys, they're giving a hint that it is covered under section 112A. Yeah, and it is a long term. It was purchased in 2016 and obviously it would be sold in our previous year. That is why we are calculating the capital gains. In August 2024, Mr. Aryan transferred a plot. Plot means only land, okay? Only land. In Chandigarh for 70 lakhs, which was acquired by him in May 2016, long term. Cost of acquisition. Hope you are getting it. Cost of acquisition is 22 lakh. Yes, sir. He paid brokerage of 1% on transfer, expenses on transfer. Okay, sir. In November 2024, Alpha Limited decided to buy back 50% of its shares at 250 rupees per share. Guys, important. First November, it is in November after amendment. From 1st October 2024, there is an amendment on buyback. Whatever you receive on buyback of shares, where is it taxable? Income from other sources. Entire buyback price is taxable under the head income from other sources as per section 222. Yeah, deemed dividend. Correct? Yes. Alpha Limited bought back proportionate shares of Mr. Aryan. Okay, 50% means how much shares Aryan is holding, guys? 20,000. In that 10,000 would be bought. 10,000 would be bought back. Yes. Yes. In May 2025, Mr. Aryan acquired a residential house property in Kanpur for 40 lakhs. He purchased new residential house. Fair market value of equity shares of Alpha Limited as on 31st January 2018 was 190 per share. Guys, when they give this itself, you should understand, you need to consider it under 112A to compute what? Cost of acquisition. When you are computing long-term capital gain under section 112A, indexation is not available. Irrespective of the date of transfer, whether it is before 23rd July or after 23rd July, it doesn't matter. No indexation. Rate will change, but indexation is not available. Anyway, they have asked only total income. You need not worry about tax rate and all. Clear? Yes. You are required to compute total income. They didn't ask only capital gains, total income. We need to take care of salary, IFOS and all. Yes, sir. Sure. Interesting question. Even this is interesting. Salary people. Salary people. What is salary? Basic pay only they are given. 90,000 into 12, 10 lakh 80. He is following default regime. What is the standard deduction? 75,000. So what is his income from salary? 10 lakh 5,000. This, please take care. Question would be silent, but still you have to take care. Okay. Next, capital gains. No house property, no PGBP. Straight away go and eat capital gains. On buyback of equity shares. Guys, buyback price is not taxable under the head capital gains, but cost is allowed as expenses, cost of acquisition, and it will become a loss. It will become a loss. First, let us go to IFOs. Where is our IFOs? What is the dividend income, guys? 10,000 into 250. Sir, what is 250? Buyback price. Sir, how did you get 10,000? He is holding 20,000 shares. 50% shares are bought back. Obviously, from him, how much will be bought back? 10,000. Correct? And company is paying for each share how much? 250. Entire sale value is taxable as deemed dividend. Yes. Sir, can they claim the cost here? No. They cannot claim cost here. Cost can be claimed where? Under the head capital gains. Okay, loose provision, but still somewhere they have given like this only. Sir, here, this is on buyback shares only. As it is done on or after 1st October 24, guys, new provision is applicable. Okay. Yes. And buyback is done by whom? Domestic company. Okay. Assume Alpha Limited is a domestic company. Yes. So buyback price, you need to take nil. Why sir nil? They have paid no sir. We consider it under IFOs. So here it would be nil. Then whatever is the cost of acquisition will become a loss. Will become a loss. Now what is cost of acquisition? Because this is covered under section 112 here. What is the cost of acquisition? Important. Actual cost of acquisition, which is 10,000 shares into 200. Take only for 10,000 shares. He purchased 20,000. But how much is bought back? Only 10,000. So please do calculation only for 10,000, not for 20,000. Okay. So actual cost is 10,000 into 200, purchase price. Then compare that with FMV as on 31st January is how much, guys? They are given. Just a minute. Okay, sir. Question is here. Okay, I have taken the question here. Yes. 190 into 10,000 shares. 190 into 10,000 shares. Got it? Yes. Hope you got it. Yes. Listen, guys. Interesting because all these are tricky calculations. Please pay attention now. Sir, here actually we need to take two things. Actual sale value, which is 0, or FMV as on 31st January 2018, which comes to 19 lakh. Whichever is lower, nil. Whichever is lower, nil. Compare that with actual cost. What is the actual cost? 20 lakh. Take whichever is higher. Hope you're understanding. Here it is nil. Here it is 20 lakh. Whichever is higher, 20 lakh. Take it. Hope you understood. This point you have to take whichever is lower. You need to compare which two figures? 19 lakh or actual cost nil. Sorry, actual sale value nil. Actual sale value is nil for buyback because it is getting taxed under the head other sources. Got it? Yes. And if you get confused, sir, how did you do this? That is nothing but 112 guys. Clear? It is nothing but done as per 112. So what is the capital loss under the section 112? Better mention the section 112. What is the loss? 20 lakh. And long-term loss can be adjusted only against long-term gain. Only against long-term gain. Yes, sir. Next, on sale of plant, should we compute capital gain? Yes, plot means only land. Please be careful. Sale consideration is how much? 70 lakh. And brokerage is paid as 1%, which is nothing but expenses on transfer. Expenses on transfer, 70,000. Net sale consideration is 69 lakh 30,000. So, sir, is indexation available? No. Why, sir? When did it transfer? When did it transfer? August 2024, after 23rd July. Sir, is a resident individual, sir, it doesn't matter. That will matter only for tax calculation. Tax calculation. There we need to do with to without indexation, apply two different rates. Yes. But here they have asked only total income. We don't care about it. Clear? So please compute capital gain without indexation and tax it under the head capital gains. Hope you are getting it. Don't get diverted from the provision because they have mentioned resident individual. You will think, oh, indexation is available. Yes, indexation is available, but not while computing the income. It is only while computing the tax. Okay. Cost of acquisition. Indexation benefit is not available on transfer which took place on or after 23rd July. So straight away only actual cost. Only actual cost. So remaining is how much? 46 lakh, sorry, 47 lakh 30,000. And is exemption available, sir? Yes. He sold land but purchasing residential house. See, if it is residential house to residential house, you can claim exemption under 54. But here it is not residential house to residential house. It is from land to residential house. So where can you claim the exemption? Under F. 54? Yeah. 54F is like you have sold any asset other than residential house. But what you are purchasing is residential house. What you are purchasing is residential house. Hope you understood because you might misapply section 54 here. What is sold is plot. What is purchasing is residential house. 54 is not eligible. Okay, sir. But 54, look at the twist here. We need to compare actual cost of new asset with what? Net sale consideration. Actual cost with what? Net sale consideration. How much is the actual cost of new asset? 40 lakh. 40 lakh. Correct. A new house. Okay. 40 lakh. Is it less than 69 lakh 30,000? Yes. How much exemption you can claim? Not full. Not full 40 lakh. Proportionately. How do we calculate it, sir? Gross gain into cost of new asset divided by net sale consideration. Divided by net sale consideration. Hope you guys remember it. I will just show you 1 second. This is only for 54F. We need to apply this formula, guys. Only for 54F. So I will go to exemption part. 54F, right? Yes. So you can see for section 54F, what should we do, sir? We need to check whether the cost of new asset, is it more than net sale consideration? If cost of new asset is more than net sale consideration, then entire cost is allowed as exemption. Entire cost is allowed as exemption. Sir, what if cost is less than net sale consideration? Then you have to use this formula. You need to use this formula. What is this formula, sir? Gross long-term capital gain into cost of new asset divided by net sale consideration. This will be the amount of exemption. That is what they are done here. That is what they are done here. Gross capital gain into cost of new asset divided by the net sale consideration. How much it comes to? 27 lakh 30,159 years. 159. This much is exempt. Remaining is taxable. Remaining is how much, sir? 19 lakh 99,841. And it is a long term asset. Correct. Now, immobile property, if it is held for more than 24 months, long term. Yes, sir. Now, can I adjust my long term loss? Where is my long term loss? 20 lakh. Against long term gain? Yes, I can do it. But I guess I cannot fully adjust. Only it is 19 lakh 99,841. Remaining 159, I can carry forward for next 8 years. Only 159 is remaining. And once you carry forward also, you can adjust it only against long-term gain. Is it clear? Sir, can I adjust this 159 against salary or IFOS? No, no, you cannot adjust. So the total income of the assessee is 35 lakh 5,000. 35 lakh 5,000. Got it? Yes. Interesting question. See, even this is an amendment. You can see, guys, they're testing the amendments. I told you there is no exclusive amendments, specific amendments for September. But still, all this was the amendment for May exams. Are they testing now also? Yes. So that is the beauty of tax paper, because the evaluator or the paper setter want to test whether the students are updated. If by chance, guys, if you don't know this amendment, then you will consider this under the capital gains only, assuming it is correct. Correct? At this 25 lakh, what do you take? You will consider it as full value of sale consideration here. And do the calculation, you believe that whatever you have done is correct. Clear? But complete twist is there. Okay? And if by chance, if you do that, entire answer will get messed up. Clear? A loss adjustment, everything will go for X. So please be careful, guys. Especially amendments, you have to be very careful. Yes, sir. Now we'll get into question number 8. Come to question number 8. Mr. Suraj, aged 40 years. Age doesn't matter here. Okay, first, is it a lengthy question? Oh, yes, sir. Okay, first let us read the requirement so that it would be easy for us. Compute the total income of Mr. Suraj, assuming that Mr. Suraj's total income is higher than Mrs. Suraj's total income. Guys, whenever they give like this, it is an in-town clubbing. Clear? So, wife income is less than husband expense. Okay, let us take care of it. Before including the income of minor children. Okay, they gave it straightforward here. Mr. Suraj exercised the option of shifting out of default regime, then optional scheme. Guys, one thing, see, please be careful. When you read this, 2-3 things has to strike to you. One is clubbing, of whom's minor children income. Whenever clubbing get attracted under section 64 1A, exemption is available under 1032. 1032. And father is following optional scheme. Under optional scheme, is it available? Yes. Okay. Sure. Fine. So the following information is given for financial year ending 31st March 2025. He is employed in APC Limited and earned a salary income of 10,50,000 computed. Everything is taken care. Sir, should I provide for standard deduction? No. He is engaged in speculation and non-speculation business. He earned a profit from speculation business and suffered a loss from non-speculation business. Look at the beauty. Sir, can I adjust this 40 against 60? Yes. Allowed. From speculation business, he has income. Whereas from non-speculation, he has a loss. Can we adjust it? Yes. But vice versa not possible. Speculation business loss cannot be adjusted against other business income. But here we have other business income. Can we adjust, sorry, other business loss? Can we adjust it against speculation business income? Yes. He reported a short-term capital gain of 80,000. He also received lottery winnings 20,000 gross IFOS. He has brought forward long-term capital loss 30,000 from assessment year 23-24, which can be set off only against long-term gain. Mr. Suraj has 2 children, one married daughter, Ria, aged 17 years, and a son, Raj, aged 16. Both are minor. The interest income of Ria and Raj is 1,200 per annum and 2,000 per annum. Clubbing. Interest, no efforts, no skill. Clubbing. Yes, sir. Which section, sir? Section 64 1A. He transferred a flat to Ria. Who is Ria? Married daughter. Sir, how can you marry a minor daughter, sir? Please don't question the question. Please follow whatever we have given. Yes. Okay. So we know it is illegal, but in the question when they are given, even in the provisions and all, they are given like that. Married daughter, not married daughter and all. Okay. Sure. He transferred a flat to Ria on 1st April 2024 on account of natural love and affection. This flat was let out from the date and generated rental income of 5,000 per month. Guys, here we need to check whether deemed ownership is applicable or the clubbing is applicable. That is in simple. Section 27 is applicable under IFHP or section 64 1A is applicable. What is applicable? Because section 27 tells the house property is deemed ownership I am talking about. If house property is transferred to a spouse or minor child without consideration or for inadequate consideration, who is deemed to be the owner? The transferor. Who is deemed to be the owner? Transferor. Okay, even though the receiver is the legal owner. But this is not applicable to married minor daughter. It is not applicable for married minor daughter. In that case, deemed ownership is not applicable. Yes. But is clubbing applicable? Yes. Clubbing is applicable. Got it? Chal, I will just show you once. Okay. Section 27 we'll see first. Let me quickly read it. Listen. Transferred to a spouse or minor child. An individual who transfer any property for inadequate consideration or gives property to his spouse. Property here means house property, okay? Because section 27 is covered under section under the head house property. Or gives property to his spouse or minor child will be treated as deemed owner of that property. Who will be treated as the deemed owner? Transfer. Though legally the owner of the property is the spouse or minor child, that is the receiver. Income from that property will be treated as whom? The income of the transfer. Where is it taxable? Under house property only. But exceptions are, you can see one exception is in case of transfer to a spouse in connection with an agreement to live apart, that is in case of divorce. The second one is in case of transfer to a minor married daughter, the transferor is not deemed to be the owner. So in simple, in our RIA case, is deemed ownership applicable? No. But is clubbing get attracted? Yes. Section 64 1. So if property is transferred to a minor married daughter, whatever income she earned from that property will be clubbed in the hands of father or mother, whoever income is higher before clubbing. Whose income is more? Father's. Suraj. It will be taxable with Suraj, guys. Okay. Next. Mr. Suraj paid a medical insurance premium of 22,000 during the financial year to insure his health, spouse, and dependent children. Allowed. Additionally, he paid 33,000 to ensure the health of his mother, aged 67 years, senior, who is not dependent on him, doesn't matter. He also incurred 20,000 as medical expenditure for his father, aged 71 years, again senior, who is not dependent and is not covered under any insurance policy. There is no health insurance policy in his name. He contributed 6,000 during the year to the central government health scheme. Let us consider this is for him. Okay, so 22 plus 6 for him and his family. Whereas for parents, 33,000 premium, whereas 20,000 is expenditure. For parents who are senior citizen, what is the maximum deduction? 50,000. Clear? For premium 50, expenditure 50. But both put together, you cannot claim more than 50. Clear? So 33 plus 20, 53. But it is restricted to 50. Hope you're understanding. Please be careful. Mother is falling under the premium category. Father is falling under the expenditure category. But expenditure is allowed only if the person in whose name the expenditure is incurred is a senior citizen plus in his name health insurance policy is not there. Condition satisfied. So how much he can claim? 20 plus 33, but restricted to 50. Restricted to 50. And for him and his family, that is spouse and children, 22 plus 6, 28, but restricted to 21. So 25 plus 50, 75 you can. Under which section, sir? 80D. 80D. So we need to compute total income. Oh, let us do it. Income from salary already computed, straightforward, take it. No standard deduction again. It is already taken care. Then PGBP. IFH will not come. Income from house property will not come. If deemed ownership would have applied, then income from house property would have come. Clear? Yes, sir. Income from speculation business, 60,000. Loss from non-speculation business. Can we adjust it, sir? Yes. Vice versa, not possible, but this is possible. Okay. 20,000. We can adjust it. Then capital gains. Short-term capital gain, 80,000 is there. Can we adjust long-term loss against short-term gain? No. Please carry forward. You have a long-term loss which can be adjusted only against long-term gain. Carry forward. So here 80,000 will be taxable as it is. Next, winnings from lottery they have told 20,000. Clear. And whenever clubbing get attracted, income is covered here itself. They have done it separately, but I would suggest you can include it under the head other sources itself. Here they have told gross total income before including the income of minor child, or else gross total income before clubbing. Clear. Sir, should we show like this? May not be. Straight away you can include the clubbing income here itself. Okay, sir. Chalo. Now coming to clubbing part, guys. Clubbing part. Ria's interest, whatever she is earning, is it clubbed here? Yes, 1,200. Plus whatever income she is earning from, income from house property, will it be clubbed? Yes. But what you have to do is, you have to calculate income from house property in the hands of Ria. The final figure has to be clubbed. Final figure has to be clubbed. Means, can she claim these deductions and all? Yes. So what is the gross annual value? 5,000 into 12. Assume that itself as GAV because they have not given any expected rent and all. Okay, sir. And they have given the explanation about 27 is not applicable, 64 1A is applicable, which I already explained. Okay. Then 30% of the NAV it is actually, but municipal tax is not there, no. So straight away they have taken 30% of GAV itself, 18,000. So what is the income from house property of RIA? 42,000. Is it taxable in the hands of RIA? No. With whom it is taxable? Father. So club it with him. Club it with him. Okay, sir. So totally how much income of Ria is clubbed with father? 43,200. Can you claim exemption under 1032? Yes. How much? 43,200 or 1,500. Whichever is low. Whichever is lower. 1,500. Okay, sir. And please be careful. He's following optional scheme. If he's following default scheme, go in the no exemption. Okay, sir. Then coming to Raj, minor son. Interest income is clubbed. Maximum exemption is how much? 2,000 or 1,500, whichever is lower. 1,500. And 1,500 is for each minor child. Yeah, yes. Sure. So, gross total income after considering clubbing figure is 12,12,200. Then deduction under section 80D, I already explained this. How much it comes to? 75. And how is it 75? They have shown you. Okay, guys, there are two categories. Let me just show it 1 second. There are two categories, associate and family and parents separately. Correct? Yes. Yes. HEG, right? Yeah. You can see associate and family separate category, parents separate category. Correct? Yes, sir. Sir, associate and family. Family means who, sir? Spouse and dependent children. Whereas when it comes to parents, dependency doesn't matter. Dependency doesn't matter. Sir, for premium, how much can we claim for associate and family? Maximum 25,000. For parents, how much we can claim? Sir, maximum 25,000, which includes preventive health checkup up to 5,000. But if any of them are senior citizens, resident senior citizen, then instead of 25, how much it is? 50,000. Clear? And if the person in whose name the expenditure is incurred is the resident senior citizen for whom medical insurance policy is not there, how much we can claim, sir? 50,000. For associate and family, 50 and parents, 50. Here for us, it is not relevant. Clear? Now, associate and family will fall in this category. How much it is, sir? So it is 22 plus 6, but maximum restricted to how much, sir? 25. Done, sir. So that will come here. 25 maximum. Then coming to parents, mother is covered here, premium category. Father is covered under expenditure category. Clear? But both put together maximum how much tax? 50,000. Both put together maximum is how much? 55. I guess it comes to 53, but it is restricted to 50. Got it? Yes. So you can see 33 premium, 20 expenditure. Both put together maximum is 50. So it comes to 75,000. 75,000 people. That's all. Total income of Mr. Suraj under optional scheme is 11 lakh 37,200. 11 lakh 37,200. Yes, sir. Sure. We'll move to question number 9. Question number 9 is on TDS. Okay. Examine the applicability and determine the amount of tax deduction at source as per Income Tax Act 1961 for the assessment year 25-26 in the following situations. First one, Nexus Tech Private Limited, a company engaged in the business of manufacturing electronic goods, reported a turnover of 12 crore during the financial year 23-24, last year. Last year turnover is given. Okay. During the financial year 24-25, the company made the following purchases from the resident sellers. Guys, company is making the purchase. That means this guy is a buyer. Clear? And buyer's turnover in the last financial year is more than 10 crore. So immediately one section has to straight to you. Which section? 194Q. If the purchase value is more than 50 lakh, TDS is applicable. TDS is applicable, but please be careful. Buyer is covered as payer. Only if his business turnover in the last financial year is more than 10 crore. Sir, is it more than 10 crore? Yes. Got it? Yes. Chalo. From vendor A means the following is a supply. Raw material worth 60 lakh, more than 50. TDS is applicable on what? 10. Correct, no people? 194Q. 25 lakh in April, 35 lakh in July. Payment of 20 lakh was made in June and remaining payment is made in September. Vendor A has not furnished. Has not furnished PAN. If PAN is not given, then what is the TDS rate? 194Q. Actually, it is 20%, but for 194Q, it is 5%. It is 5%. Only for 194Q. If it was any other section, then actual rate or 20%, whichever is higher. But if it is 194Q, if seller has not given the PAN, then how much TDS has to be deducted? 5%. Okay. Next. From vendor B, trading goods worth 48 lakh within the limit. On installments, 15 lakh in May, 20 lakh in October, 13 lakh in December. Entire payment was made in March. No problem. Guys, please be careful. 50 lakh limit is not overall. It is seller wise. Seller wise. So from vendor A, I have purchased worth how much? 60 lakh. Is TDS applicable? Yes. Whereas from vendor B point of view, only 48 lakh within 50 lakh. Is TDS applicable here? No. Please don't take aggregate from all put together. It is seller to buyer wise. Okay, each person we have to take 50 lakh. It is to be noted that Nexus Tech Private Limited made the entry in its books on the date of purchase. Entry date is passed on date of purchase, and TCS provisions are not applicable to vendors. Okay, fine. Then we will see. See, I will just show this 194Q. Quickly. See, I have explained this. You need to study this along with section 206C1H. But only for buyer, if section 194Q is not applicable. You will go and check section 206C1H from seller point. And they clearly told no TCS is applicable from seller point of view. So we need not worry about this section as. We need not worry about this section. Okay. Sir, when is section 194Q applicable? When there is a purchase of goods worth more than 50 lakh in 1 year from one seller, single seller. Okay. Buyer is whom? Buyer is a person whose business turnover in the last financial year is more than 10 crore. Okay. Seller is whom? Any resident. What is the TDS rate? 0.1% of the sum exceeding 50 lakh. Clear. But if if seller has not given his PAN, then it would be 5%. Where is it given, sir? Section 206 AA. A. When TDS has to be deducted, sir? At the time of giving credit of such amount to the account of payee or at the time of payment, whichever is earlier. Whichever is earlier. Okay, sir. Simple. So we have read this. Now let us go and answer it first. Since because lot of things to connect, even PAN is not given, so you cannot straight away deduct 0.1%. You have to deduct 5%. Since turnover of Nexus Private Limited exceeds 10 crore during the previous year 23-24, it is required to deduct tax at source under section 194Q for paying any sum to a resident for purchase of goods of the value exceeding 50 lakh in the previous year at the time of payment or at the time of giving credit, whichever is earlier. The rate of TDS would be 0.51% of the sum exceeding 50 lakh. In case of non-furnishing of PAN, TDS would be at what rate? 5%. would be deducted as per section 206 AA. Guys, for other sections and all, it is actually 20% or actual rate. Whereas only for 194Q, they have told 5%. TDS liability in respect of purchases made by Nexus Private Limited is as follows. The threshold limit of 50 lakh is exhausted in July at the time of credit. For whom? Vendor A. Accordingly, tax would be deducted by Nexus Tech Private Limited only on 10 lakh. That is 60 minus 50. 60 lakh minus 50 lakh. Understanding, Mohan? On 10 lakh, how much TDS has to be deducted? 5%. So on 10 lakh, 5% comes to how much, guys? 50,000. So 50,000 TDS has to be deducted. Clear? Not 0.1%. Why 5%? Because the seller didn't give his PAN. If he had given his PAN, then on 10 lakh only 0.1%. Oh. Then purchase of trading goods from vendor B, TDS is not applicable. Why, sir? Because the purchase value is within 50 lakh. Within 50 lakh, and sometimes they may give GST and all and confuse you. For example, 48 lakh plus GST they will tell. If you include GST, it is more than 50 lakh. If you exclude GST, less than 50 lakh. What should you do? Take 48 lakh. For TDS purpose, you have to exclude GST. You have to exclude GST. In this question, they have not given, but by chance, if they want to confuse more, they will give it. Clear? Please consider the figure before GST. That is excluding GST. Okay. One more sub question. In January 2025, Mr. Sumit engaged in the business of having turnover of 1.2 crore during the previous year 23-24, last year. Enters into an annual maintenance contract AMC with ABC Limited, a resident company, for 5,40,000 plus GST 18%. Mr. Sumit made the payment in February 2025 and ABC Limited has not provided its PAN to Mr. Sumit. Again, no PAN. Okay. And where this will come, sir? 194C. Under 194C, what is the threshold limit, sir? 30,000 for single payment, aggregate payment 1 lakh. Both is crossed. I need not worry, sir, whether it is single law, multiple law, installment law, doesn't matter. So is TDS applicable? Yes. Is it on 5,40,000 or 5,40,000 plus GST? Guys, on GST component, TDS is not applicable. So please be careful. It is on 5,40,000. It is on 5,40,000. Yes, I will go to the answer now. Since the turnover of Mr. Sumit exceeds 1 crore during the previous year 23-24, individual is an individual. Last year, was he subject to tax audit? Yes. As his business turnover is more than 1 crore, he would have been subject to tax audit. Clear? In the current year, is he covered as payer? Yes, he is covered as payer. Okay, sir. And the contract payment made to ABC Limited exceeds 1 lakh or single payment more than 30,000. The TDS provision under section 194C would be attractive. The rate of TDS under section 194C would be 2%. Why 2%, sir? Payment is made to whom? Hello? Payment is made to whom? I mean turnover. With ABC Limited. Who is ABC Limited? Not an individual or HO. If payee is an individual or HO, what is the TDS rate? 1%. For others, what is the TDS rate? 2%. But even 2% is not applicable. Why, sir? PAN is not given, no? But you have to explain it. Actual rate is 2%, but as the payee didn't give PAN, we will deduct at 20%. Yes. However, as per section 206 AA, in case of non-furnishing of PAN, TDS could be deducted at 20%. Both the question you can see, it is on 20%. Sorry, 206 AA. You have to first explain whatever is the actual section. Then only tell, as PAN is not given, we will deduct it at so and so rate. Yes, so 20%. In the present case, ABC Limited has not provided its PAN to Mr. Sumit. Hence, TDS at 20% is applicable on 5,40,000, being the amount excluding GST, as GST separately mentioned. So only on 5,40,000, we need to deduct 20%. 20%. I will just show you 194C, right? Yeah, you can see contract payment. If single payment is more than 30,000 or if aggregate payment is more than 1 lakh, TDS has to be deducted. Here anyway, whether it's single law, aggregated, doesn't matter, it has crossed. Okay. TDS at what rate, sir? 1% if pay is an individual or HUF. Or if pay is other person, then 2%. In our case, it is 2% because the pay is a company. Is a company. Then, sir, payer means no. Payer includes any person. But individual or HO who was not subject to tax audit last year is not covered here. But for Sumit, they gave the turnover in the last year, which is more than 1 crore. So is it subject to tax audit? Yes. So is he covered here? Yes, he's covered. Got it? Yes. And I will also show you guys 206 AA. Actually, we have applied for both the questions, but I will just show you. Just a minute. Yes, this one. In this note is there. First note, let me read. If pay, this is in case of TDS. If pay doesn't provide a span, then TDS has to be deducted at 20% or rate as per the respective section. That is actual rate, whichever is higher in all cases. Except in respect of payment made to non-corporate, non-residents or foreign company. That is, if the pay is the following people, then 20% is not applicable. But when it comes to 194Q, what is the rate of TDS? If pay has not given a span, 5%. We apply this. This provision is given in which section, sir? 206. A. Oh. Chalo. Last question. Last question is on total income. Oh. Chalo. Let me read the requirement first. You are required to compute the total income of Mr. Shobit and also tax payable by him after TDS TCS credit, if any, for the assessment year 25-26, if he is opting out of default tax regime, means he is following optional scheme, guys. Okay, only one scheme, sir. Sometimes they will ask both the schemes also, that becomes more challenging. Time taking. Mr. Shobit, a resident individual, age 54 years, age will not matter, engaged in manufacture of spare parts of cars. He follows the mercantile system of accounting and regularly files his return of income. Very good, Shobit. The profit and loss account for the year ended 31st March 2025 shows a net profit of 57,25,000, which we will take it as a base. After debiting or crediting the following. Yes. During the year, Mr. Shobit, means the following items are either debited or credited. So what should we do? We need to take this as a base to compute the income under the PGBP and make necessary adjustments. That is plus minus. During the year, Mr. Shobit purchased plant and machinery for 55 lakh, for which he took a loan from a scheduled bank. Date of loan 1st May 2024 and rate of interest is 11% per annum. The asset was acquired on 1st July 2024 but put to use on 1st September 2024. Guys, important. The entire interest amount is debited to profit and loss account. Is it right? No. If a loan is borrowed to purchase an asset, then whatever interest is paid till the date the asset is put to use has to be capitalized. Clear? So from date of loan, when did we take the loan? From 1st May to 1st September. Whatever interest is there has to be added to the cost of plant and machinery. And after that, whatever interest is there, yes, it is a revenue expenditure, you can claim it. Hope you understood. Entire interest they have debited to P&L account. Is it right, sir? No. A part of the interest has to be capitalized. For how many months, sir? From May, June, July, August, for 4 months. For 4 months, whatever interest is there, it has to be capitalized. So in P&L account, they already debited it. What should you do? Add it back. And you go and add it to the cost of plant and machinery. On that, can you claim depreciation, sir? Yes. So cost of plant and machinery would be 55 lakh plus interest for 4 months. On 1st April 2024, the production manager working in the factory of Mr. Shobit took voluntary retirement from the services. Mr. Shobit paid him 8 lakh as compensation for his services under the voluntary retirement scheme. Guys, 8 lakh which is paid as VRS compensation. Can it be claimed as deduction? Yes, but in 5 equal installments. 5 equal installment as per section 35 DDA. As per section 35 DDA. You would have debited entire 8 lakh. Now we need to disallow how much? 1/4 of, 4 by 5 of it. 4 by 5 of it we will disallow. Why, sir? Because in the current year only 1/5 is allowed. Remaining will be allowed for next 4 years. Next 4 years, guys. Next, third. Mr. Shobit purchased a raw material from Kamal and Sons a micro enterprise, and Hitesh and Sons, a medium enterprise. Guys, please be careful. For medium enterprise, section 43B is not applicable. 43B is applicable only for micro and small enterprise. In the definition of MSME, even medium is there. But in our 43B of Income Tax Act, they are not covered. That is 43BH. Hope you remember it. Medium is not covered, hence we will not apply 43B. For 51,000 and 75,000 respectively on 15th March 2025. As per the written agreement with them, both the payment has to be made by 10th April 2025. Means when there is a written agreement, we need to make the payment as per the agreement or within 45 days, whichever is clear. Whichever is earlier. Mr. Shobit made the payment to Kamal and Sons on 9th April. What was the date of transaction? 15th March. And payment is made on 9th April. Sir, is it made within the time? Yes. Is it allowed? Yes. In previous year 24-25 itself, it is allowed. Whereas for Hitesh and Sons, they made it on 15th November 2025. It doesn't matter. Why is that? Hitesh and Sons is a medium enterprise for which 43B is not applicable. 43B is not applicable. Okay, sir. Just a minute. I will show you. You can see 43BH. There is a separate provision for it. Okay. Sum payable by the associate to micro or small enterprise for supply of goods or services beyond the time limit specified in section 15 of MSME Act is disallowed in the current year. It will be allowed when the payment is made. Correct. But what is covered here is only micro and small. Check, is there a written agreement? In our case, it is there. Payment has to be made as per what? As per agreement or within 45 days, whichever is earlier. Whichever is earlier. So only one payment is covered here. The other payment made to medium enterprise is not covered under section 43PH. Please be careful. Whereas for micro and small enterprise, if the payment is made with after this, is it allowed, sir? Yes, but in the year in which payment is made. In the year in which payment is made, yes. Okay, sir. Sure. Coming back to this. Sure. So both are allowed. Both are allowed. No problem. Here actually payment is made after the time, but it is a medium enterprise. Section 43DH is not applicable for payment made to medium enterprises. Fourth one. He contributed 20% of his basic pay to the account of each employee under a pension scheme referred to in section 80CCD, which is debited to profit and loss account. Basic salary, the employees aggregate to 10 lakh and dearness allowance is 40% of basic salary and it forms part of retirement benefit. That's simple. Whenever employer is contributing to the pension scheme of employees under section 80CCD, how much is allowed, sir? Only 14% of salary. Only 14% of salary is allowed as an expenses for the employee. But how much he has contributed here? 20% of basic pay. 20% of basic pay. Just a minute. I will show you. Just a minute. Everything should be shown. Proof ಬೇಕು sir. PGBP. It is covered under the head PGBP. Okay. Finding the right provisions with page number is challenging here. So many pages. Yeah, I got it. Yes, please look into this. This one. Employer contribution to the account of employee under a pension scheme referred to in section 80CCD as per section 36(1) 4A. How much is allowed, sir? 14% of salary. And what is salary for this purpose? Basic pay plus DA. DA means if the terms of employment provide. Clear? Employer is contributing 20% of basic pay. Is it fully allowed? No. Only 14% of salary. And what is salary here? Basic pay plus DA for DA condition attached. For DA condition attached. Yes, sir. Sure. Coming back. Depreciation debited to profit and loss account is 27,50,000. Then debited to profit and loss account means is it allowed or disallowed? Disallowed, sir. Why? Because this will be as per accounts. We need to calculate as per income tax law and allow it. He received 13,850 as income tax refund, out of which 3,850 is interest on refund. Interest on refund. The entire amount is credited to profit and loss. The entire amount is credited. So what should we do? Deduct it. But include only interest part under the head other sources. Okay. Additional information. Mr. Stobit, additional information means, guys, whatever is debited and credited is done and dusted. Now they are giving something extra. What is it, sir? Mr. Shobit purchased a new computer on 31st August 2024. Okay, more than 180 days. More than 180 days. And was put to use on the same day in his office. The payment was made as under 28,000 paid in cash at the time of purchase of new computer on 31st August 2024. What is the cost? Zero. What is the cost? Zero. Why, sir? It is paid in cash. So can we include the cost of the asset in actual cost calculation? No. Zero. Next. 25,000 paid by account pay check on 5th September 2024 as balance cost of new computer. On this you can claim depreciation. This is the actual cost. Only this is the actual cost. Okay. WDB as per Income Tax Act 1961 of different asset as on 1st April 2024. Plant and machinery already 8 lakh was there. Plus I guess 55 lakh purchase is there. 55 lakh purchase during the year, people. This one. Plus for this interest also we have to take. Till when, sir? For 4 months. Clear? Plus opening value. And when was this purchase put to use? 1st September. More than 180 days. More than 180 days. Yes. Factory building 6,45,000. And guys, please be careful. They have given the depreciation here. You need to add back this. You need to calculate depreciation as per section 32 and allow that. And allow that. Next. He paid 50,000 as life insurance premium taken on the life of his father, who is dependent on him. Father. We discussed about it. For father, is life insurance premium allowed as deduction for a son? No. Life insurance premium is only for assessor, not for parents. The sum assured is 8 lakh and the policy was taken on 1st April 2015. Doesn't matter, no ATC deduction. No ATC deductions. He also paid 45,000 as life insurance premium taken on the life of his married daughter. Okay. Who is not dependent on him. Doesn't matter. The sum assured is 5 lakh and the policy was taken on 1st April 2017. Guys, 5 lakh into 10% comes to 50,000 and here it is 45. It is within the limit allowed. Enjoy. On 1st October 2024, he withdrew 1.5 crore in cash from 2 current accounts maintained by him with PNB Bank of India. There was no other withdrawals during the year. Guys, TDS is applicable. Under section 194N. Is withdrawing more than 1 crore, na? Yes, on that TDS is applicable. Sir, how, sir? I will just show. One second. 194N, guys. Yes. You can see, as per section 194N, if more than 1 crore is withdrawn, more than 1 crore, if they are not given about all these guys, don't apply 20 lakh. You apply 1 crore. He is regularly filing the returns also. So you will not be covered. Okay. If he is withdrawing more than 1 crore, what is the TDS rate? 2% on the sum exceeding 1. 2% on the sum exceeding 1 crore. How much is actually withdrawing? 1.5 crore. So only on 0.5 crore, TDS would be applicable. Only on 0.5 crore. Mr. Shobit had sold a house on 30th March 2022 and deposited the long-term capital gains of 25 lakh in capital gains account scheme by the due date of filing the return of income for that year. Guys, if assessee is willing to purchase a new asset and he want to claim exemption now, then he can deposit the amount into capital gains accounts scheme and claim exemption. But within the period, means if he is willing to purchase the house, within 2 years he has to withdraw and purchase the house. Or if he is willing to construct within 3 years, he has to withdraw the money and construct the house. Oh. On 1st July 2024, he sold another house property in which he resided for 1 crore. He earned a long-term capital gain without indexation, 50 lakh. Okay. On sale of this property, when did he sell? 1st July. Indexation is actually available. Before 23rd July, indexation is available, but they have given He earned a long-term capital gain without indexation, 50 lakh. Confusing. On sale of this property. On 5th January 2025, he withdrew the whole of the money out of his capital gain account and invested 60 lakh on construction of the house in Mumbai. The construction of the house was completed on 23rd March 2025. The index cost of acquisition of this house property is 60 lakh. Guys, bit tricky. Please pay attention. Bit tricky. When did the old house was transferred? 30th March 2022. So capital gains will already been taken care in 21-22. We're not bothered about it. But he deposited 25 lakh in capital gains account scheme. Got it? Yes. He has already claimed exemption in which year? 21-22. But he should make sure that this amount is withdrawn and construction is completed within 3 years. Within 3 years. Yes, sir. When did he do it? 30th March 2022. Okay, now transfer of old asset. Within 3 years, a new house has to be constructed with this money. Is it completed, sir? 23rd March 2025. Yes, it is done. That means exemption will not be withdrawn. Sir, what? If it is not completed within 3 years, then whatever exemption he has claimed earlier will be withdrawn and it would be taxable. In this case, will it be withdrawn? No. When he has claimed this 25 lakh exemption in the current year or in the year 21-22, he has already claimed it. But we should ensure that he is using this money within 3 years for the construction of property, which is tick for us. Tick, not a problem. Okay. Then totally he is investing how much into the new house, guy? 60 lakh. Will he get full exemption? No, because he has already enjoyed 25 lakh. What is the exemption he will get in the current year? 60 minus 25. 60 minus 25, 35 lakh. Correct, people. Why? Because the cost of new house is 60 lakh, for which already exemption is given 25 lakh. When? In 21-22. Can he claim exemption again for it? No, because by mistake you might give exemption full 60 lakh. Don't do that. 25 lakh is already given. Now he is using that money. He is eligible. What about the remaining amounts? 60 minus 25. Can he claim it? Yes. Okay. One more thing. What is the long-term capital gain? Is it 50 lakh? No. See, they made your work easy, thinking it is correct. If you take it rightly, then you are actually. Why, sir? Because indexation is available. Indexation is available. What is the index cost? They have given 60 lakh. What is the sale value, guys? 1 crore. So what is the long-term capital gain? 1 crore minus 60 lakh. It would be 40 lakh. Hope you are getting it. It is not 50 lakh. It is 40 lakh. Why, sir? Because the date of transfer is before 23rd July. Is indexation available for long-term capital assets? Yes. Indexation is available. Got it? Yes. Take care of. That's all. Few points are tricky. Others and all is like as usual, guys. As usual. Yes, sir. Now coming to the answer for question number 10, we'll see there is no income from salary and house property for the assessee. Straight away, we will go it under the head PGDP. Income from business or profession. What is the net profit? We will take it as the base 57 lakh 25,000, which is already given in the question. So add items of expenditure not allowable, but it is already debited to P&L account one by one. Depreciation as per books, we are disallowing it. We will calculate as per section 32 and we will claim it. Okay. Next, interest on loan taken for purchase of plant and machinery. Guys, whatever interest is paid up to the date the asset is put to use has to be capitalized and added to the cost. So how much is that, sir? For 4 months, 55 lakh into 11% into 4 by 12. Only for 4 months. Sir, why only 4 months? Till the asset is put to use, whatever interest is there, we will capitalize. After that, whatever is there is the revenue expenditure, you can claim it. That we will not disallow. Only from date of loan till the date the asset is put to use. 4 months it comes to. So how much is the interest? 2,01,667, guys. You add it. And this amount has to be added to the cost of plant and machinery. What would be the cost of plant and machinery? 55 lakh plus 2,01,667. On that you can claim depreciation. Okay, sir. Next, compensation on voluntary retirement. I told you this is allowed in 5 equal installment as per section 35 DDA. So entire amount is already debited. So what should we do? In the current year, I can claim only 1/5. Remaining is how much? 4/5. Disallow now. Disallow no, but you can claim it over a period of next 4 years. So 4/5 we are disallowed. Yeah, 1/5 is allowed, remaining 4/5 we are disallowed because only 1/5 can be claimed in the current year, guys. So 8 lakh into 4/5 we are disallowing 6 lakh 40,000. Then payment made to Kamal and Sons, a micro enterprise, it is made within the time, hence allowed. It is paid in April, but is it paid within the time limit given in section 43BH? Yes, it is allowed on accrual basis, not on payment basis. Clear? Sir, what if it is paid after the due date as per section 43BH? Then it will be allowed in the year of payment. Clear? So here it is paid within the time limit as per the agreement, so no problem. No problem. Next, payment made to Hitesh and Sons. Guys, it is not at all covered in section 43BH. Why, sir? Because it is a medium enterprise. Medium enterprise. So it is allowed on mercantile basis. That is accrual system. Clear? Irrespective of when it is paid, it is allowed on accrual basis. Next, excess contribution towards employees' pension scheme. We spoke about it. Employer is contributing how much? 20% of salary. Sorry, basic pay. 20% of basic pay comes to how much, guys? To 10 lakh into 20%, 2 lakh. But how much is allowed as an expenses is only 14% of basic pay plus DA. For DA condition is there, which comes to 10 lakh into 14% plus on 4 lakh also we have to take. Only 40% is forming part of retirement benefits, I guess. Just a minute, I will read it. DA is also there. Okay. Dearness allowance is 40% of basic salary, which is forming part of retirement benefit. So 10 lakh into 40%, 4 lakh it comes. On 4 lakh, we need to take 14%. So totally 14% has to be taken on 10 plus 4 lakh. Clear? That much is allowed, remaining is disallowed. Remaining is disallowed, people. Okay. So how much is that? So 14% of 14 lakh, which comes to like 2 lakh minus 14% of 14 lakh, remaining is 4,000. 4,000 is disallowed. 4,000 is disallowed. Guys, for this, we need to check two sections. Which are those, sir? 36, which I already showed you. Another is 40A9. 40A9 will tell if there is any expenses beyond the limits. Beyond the limits, then it is disallowed. So, more than 14% is more than the limit. Clear? I will just show you. Oh, I will show you. 1 second. PGBP heading. I have already shown the provisions under section 36(1), which is talking about 14% of salary. Yes. So see here, we have already shown this 14% of salary is allowed, but as per section 40A9, 40A9, what is it telling, sir? Just a minute. Yes, you can see. 40A9. No deduction shall be allowed in computation of taxable profit in respect of any sum paid by the assessee as an employer towards the setting up or formation of or as a contribution to any fund, trust, company, association of person, body of individual or society, or any other institution for any purpose, except where such sum is paid by the assessee as an employer or contributed within the limits. If it is within the limit, is it allowed, sir? Yes. What is the limit? Only 14%. If it is beyond the limit, then the remaining is disallowed. Then the remaining is disallowed. So what was beyond the limit? 4,000. Disallowed. 4,000 is disallowed, people. Okay. Next, coming to what can be deducted. Guys, this is the income which is credited to P&L account. Entire amount we need to remove. But only interest part will be included under the head income from other sources. Next, allowable expenditure. Depreciation we will claim by calculating it. So, normal depreciation first. On opening WDV, factory building 10%, plant and machinery 15%. This is only on opening WDV. Then computer acquired on 31st August, full depreciation. But whatever is paid in cash is not allowed as cost. Only remaining amount you take. Only for 25,000. Only for 25. 28 is not considered because it is paid in cash. Okay. So 25,000 into 40%. Okay, sir. Next. On plant and machinery, guys, cost is actually 5 lakh plus interest should be capitalized. Up to the date the asset is put to use. I already told you about this. We need to capitalize it. Now, what is the actual cost after considering interest? 57 lakh 1,667. So you can claim 15% depreciation on it, full, because it is used for more than 180 days. Okay, sir. On this, can we claim additional depreciation also? Yes. Assessee is, I guess, manufacturer. Shobit. Correct? Manufacturer. Can you claim additional depreciation? Yes, sir. But please be careful. Computer, they clearly told they've installed. Just a minute. Computer. In the office. Even actually, computer also will come under plant and machinery, but different depreciation rate. But it is installed in office. So for computer, please don't provide additional depreciation. Okay, only for plant and machinery, assuming it is installed in factory, additional depreciation on 57 lakh 1667, full 20%. Full 20%, guys. Oh, then coming to capital gains. Guys, capital gains also is tricky. Take sale consideration. Reduce what? Index cost of acquisition. Why, sir? Indexation is available. They've straight away given one capital gains. Don't take that because that is without indexation. You reduce index cost of acquisition. You will get long-term capital gain 40 lakh. Sir, why indexation is available? Because the date of transfer is before 23rd July. Oh. Then exemption is available, huh? Yes. See, total investment is 60 lakh, but already 25 lakh exemption is available, already claimed. So remaining is how much, sir? 35. So claim for 35 lakh. Remaining taxable is how much? 5. Hope you're understanding. Total construction cost is 60, guys. Already 25 lakh was there in the capital gains account scheme, which you are withdrawing and using it. Can you claim exemption again? No, sir. It was already claimed in the past. No exemption again. Okay. So remaining 35 lakh you claimed. Long-term capital gain, which is taxable, is 5 lakh. Then other sources, 3,850. Only interest on refund. Only interest on refund. So we will get a gross total income of 76 lakh 20,584. Then deduction under section 80C. For whatever life insurance premium paid for father, no deduction. For parents, you cannot take life insurance policy. Even if you take and pay, no deduction under 80C. But sir, is health insurance premium or medical expenditure allowed? Yes, under 80D. Under 80D. Sir, what about for daughter? Is it allowed, sir? Yes. So 5 lakh is the policy amount. 10% of 5 lakh comes to 50,000, but premium paid is 45. Claim full. Claim full. 45,000. Oh, total income is 75 lakh 75,584, which we will round it up to nearest to 10 rupees as per section 288A. So 580. 580. Okay, sir. Now coming to tax calculation. Guys, first check whether income includes any special income. Yes. 5 lakh is special. Where is it covered? 112. 112. Okay. Anything else? No. All other business. So only 5 lakh is special. First calculate tax on 5 lakh. Guys, as the date of transfer is before 23rd July, what is that tax date on 5 lakh? 20%. Which section? They have actually not mentioned the section, better mention 112. 112. So on 5 lakh, 20% comes to 1 lakh. Remaining income is a normal income. Remaining income is how much, sir? 75 lakh 75,580 minus 5 lakh. Minus 5 lakhs. So it comes to 70 lakh 75,580. He is following optional scheme. Age is less than 60. So what is the basic age limit? 2 lakh 50. So up to 2 lakh 50, nil. 2 lakh 50 to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. 10 lakh to 70 lakh 75,580. I don't know why they have taken 85 here, which is wrong. It is 75 actually. Clear? So I repeat, 10 lakh to 70 lakh 75,580. So you do like this: 70 lakh 75,580 minus 10 lakh into 30%. Into 30%. Are you getting this figure? Figure wise correct. Maybe here by mistake they have taken 70. It should be 75. Okay. So we will add up both. Tax on special income plus tax on normal income. What do you get? Gross tax liability. This is called gross tax liability. Sir, is surcharge applicable? Yes. Total income is more than 50 lakh. 10% surcharge. 10% surcharge. So on 20 lakh 35,174, 10% surcharge comes to 2 lakh 3,517. Add up both. On this 4% sales tax. No rebate here. 4% sales. So final tax liability comes to 23 lakh 28,239. Don't round off this because TDS and all is there. TDS under section 194N. In excess of 1 crore, whatever you have withdrawn, it will be considered as TDS sum on 50 lakh 2%, which comes to 1 TDS. Clear? And please be careful, sir. You didn't consider this as an income. This is not an income. I had stressed on this when we were covering 194N. Sir, when we are withdrawing the money from our own ATM, is it my income? No. But for whatever TDS is deducted by the bank, will we get a credit for it? Yes, credit we are getting. Credit we are taking. So what is the amount payable after TDS? 22 lakh 28,239. Round it off. 240. Yeah, as per section 288. Got it? Yes. See, while doing the answers, guys, especially while computing total income, don't do like how they have shown here. Okay, too much lengthy calculation you can see here. All explanation they have given here itself. Better give it by way of note. Okay, when we were covering the total income questions and all, wherever required, I had given a note. Now, hope you remember. Do like that. Because when the main answer becomes too lengthy, it will become difficult even for the evaluator. Clear? So try to give the explanation wherever required by way of note, guys. Is that clear? So this was the direct tax component from September 2025 RTP.